An awful lot of people view valuations and they have a generalized view that price to earnings is all you need to look at in valuations, and that couldn't be further from the truth. Price to earnings ratios ignores how a company is capitalized. Is it true debt or is it true equity? And based on that, the actual valuation and the performance of a company is dramatically different depending on the circumstances. So I have an example in front of you guys of two different companies. So assume there's two identical enterprises. These are exactly the same, operating in the same industry. That's company A and company B. So company A is capitalized 100% with owner's capital. So it's 100% equity. It's all the money from the owner. He's put it into it. There's zero debt in the balance sheet. Then you have company B. Now that's an 80% loan to value. So the owner came up with, for argument's sake, this is $1 million business. He found $200,000 and then he went to the bank and borrowed another $800,000. And together that created a company worth $1 million. Here's where the issue comes. So company A is obviously going to have a better performance than company B, because company A doesn't have to service any debt repayments. So their EPS, for argument's sake, in this circumstance, is $2, no debt service costs. Company B is $1.85 because we have to exclude the debt service costs. If you're the owner of a business, you're more incentivized to use debt, provided that you can service that debt. If interest rates are rising and you can no longer service that debt, you've effectively put $200,000 at risk. If you're company A and you put all the money up front, you don't have those worries. So there's a bit of a conundrum when we look at price to earnings because it doesn't differentiate debt or equity when the company is capitalized. And that's very, very, very important. So what I use as a more effective route to come to a valuation of a company is enterprise value to operating profits. So what is enterprise value? Enterprise value is essentially what is needed, the bare minimum that's needed to operate a business. So for argument's sake, say you had a business, it's worth $1 million. How much do I need to come up with to buy that company? So the company operations may only be $800,000 and then they've got excess cash of $200,000 on the balance sheet in short-term investments or whatnot. That $200,000 cash is not necessary when I want to buy the business. I only care about what do I need to buy that company if that's what my intentions are, and it's $800,000. So that's what we factor in for enterprise value. Now the market typically look at PEs. Then when you get a slightly more intellectual investor, they look at enterprise value to EBITDA. But I think that metric again is a little bit flawed. The reason I think enterprise value to EBITDA is flawed is because EBITDA, which is earnings before interest, tax, depreciation and amortization, is not a true representation of every dollar that you earn as a company owner. Operating profit would do that for you. It X out all the expenses. So I look at enterprise value to operating profit. Not many people in the industry look at that metric, but it's a very, very, very efficient metric to follow. So how do we calculate enterprise value? Enterprise value is essentially the market cap plus the debt minus the cash. Now a lot of people are wondering why cash. A moment ago I just mentioned that we take the excess cash off the books because we only care about what do we need for this enterprise to operate efficiently, and that excess cash is not necessary. So we want a true representation of what the company is actually worth. So let's go through a working example. Over to Google, where you find all this, finance.yahoo.com. Everything is on here. This is a fantastic website. We'll search, for argument's sake, Microsoft. Let's look up Microsoft. And what we'll find here is if we click on statistics, we'll actually find an enterprise value here. However, as you can see there's a little 3 beside it. Go down here to the right hand side. Number 3 suggests that data derived from multiple sources or calculated by Yahoo Finance. Not really effective. We don't actually know how it's calculated or when it was calculated from. So we're going to do that ourselves. Enterprise value, market cap. Pull up our calculator. So we'll key in the market cap. And the market caps are usually quite accurate. The reason being it's very simple. It's a multiple of the share price times the outstanding shares. You can do that yourselves just to make sure, but the enterprise value, it's a little bit more maths. And as I said, it's better to calculate it yourself if you want a more holistic view of what the company is actually valued at. So 816 billion, that's what Microsoft is valued at. Now from there, we need to add the debt. So over to financials, let's look at the balance sheet. Let's scroll down on the balance sheet till we find debt. So we should find long-term debt. We need long-term and short-term debt. So we'll add that. So plus 77,810,000,000. That gives us 894 billion so far. Now we need to add short-term debt. So short-term debt here, 5 billion. Add that to it as well. Plus 5397. We're up to 899 billion, almost 900 billion here. Now what we need to do is we need to exclude cash and cash equivalents. What's not necessary for the business? So what's not necessary is cash, almost 12 billion here, and short-term investments, 121, almost 122 billion. So minus 11,946,000,000. And now we need to minus out 121 billion of short-term investments. That gives us 766 billion. That is our enterprise value. So let's go over and look what Yahoo has as enterprise value. 766 billion is our number. They have 742 billion. Now that could be a number from 2 months ago. It's not necessarily wrong. It just depends on when it was calculated. This is our more efficient number. Let's call it that. Now we've got enterprise value. Now what we want to do is minus out net income. So what we got to do is back to the profit and loss statement or the income statement. And if we go down to the bottom here, we'll find net income from operating operations. And then if there's any non-reoccurring events, they'll exit out here. And then you get your net income here. So we're going to divide the enterprise value by the net income. So divided by 16,571,000,000. That gives us a ratio of 46.24 to 1. In other words, what it costs to operate this business, for every $46.2 it's worth, we receive 1 of real actual dollars in our pocket. So let's have a look at that relative to price to earnings. So statistics, price to earnings, trailings, 43.81. Not a massive variance, but depending on how the company reports, that number will be very different. So you might see a company where it might have a trailing PE of 20 and the enterprise value to operating income might be as high as 40, 45. It's a true representation. It's easier to get to the bottom and the core of the valuation of a company doing it this way. So that is essentially the first metric we follow, enterprise value to operating profit or operating income, operating net income. Next, we're going to look at the cash statement. There are essentially three financial statements that are reported. There's the income statement or the profit and loss statement. You got the balance sheet, and then you got the cash statement. In the cash statement, there are 3 different sections. You got cash from operating activities. This is cash inflows and outflows from a company's main operations and activities. The next section is investing activities, cash flows provided by or used in, and then there's a list of what they are. So this reports the aggregate change in a company's cash position resulting from investment gains or losses and changes resulting from amounts spent on investment in capital assets such as plant and equipment. And then finally, at the very end of the cash flow statement, you will see cash flow from financing activities. This is accounts for external activities that allow a firm to raise capital. In addition to raising capital, financing activities also include repaying investors, adding or changing loans, or issuing more stock. Now, from this statement, there are 2 different metrics we need to follow in order to get a clear representation of whether this company's got a good valuation and how are they situated in terms of liquidity moving into the future. The first thing we need to do is calculate cash flow per share. Cash flow per share is calculated as operating cash minus dividends divided by shares outstanding, and that'll give you the cash flow per share. Then we take the cash flow per share and we divide it by the share price, and then we get the price to cash flow ratio. And that'll give us a representation of, depending on the industry, what the kind of liquidity is. In certain industries, you're going to see higher price to cash flow ratios versus others. And what I mean by that is, if you've got a very capital intensive business, say it's mining, you want to see a much lower price to cash flow ratio because they need a lot of cash flow to service that business. If you've got a software business, for argument's sake, say Netflix, that the majority of the business is actually streaming, the cash flow ratio could be a lot higher. In Microsoft's case, it could be a lot higher because they provide an awful lot of services through software. So it's not capital intensive. So it's very important to understand what industry you're investing in and the capital requirements for that industry, whether it's mining, whether it's manufacturing, whether it's providing a service. So let's go back over to the financial statements and let's start working this out. Click on financials. Down here, click on cash flow statement. So what we're looking for is operating cash. So first segment here, as we pointed out a moment ago, operating activities. This is total cash flow from operating activities. So make sure that the date is correct. Make sure you're on quarterly to get the latest reports. And this is the 30th of September 2018. So what we're looking for is total cash from operating activities. 13,657 million, and we need to exclude the dividends. So minus, let's have a look here for dividends. If we scroll down further, you'll find dividends paid, 3.22 billion. Let's open our calculator and minus 3.220 billion. So that gives us 10.437 billion. What we need to do now is divide that by the shares outstanding. So back up to the top of the page, click on statistics here for Microsoft, scroll down, and what we're looking for is shares outstanding. So we have 7.68 billion shares outstanding. So we need to divide this by 768 billion. And that'll give us a ratio of 1.35 to 1. So essentially what this 1.35 is, it's $1.35 per share of cash flow that this company is generating on a quarterly basis, not an annual basis. The number would be a lot higher if we were looking at it on an annual basis, probably 4 times higher, closer to $4. However, we're looking for a metric that shows us the performance over time of cash flow in this business. So we're following the quarterly reports because it gives us the latest information on the company. The next piece of data we need to find is price to cash flow ratio. So what we got to do is get the share price and divide it by the cash flow dollar amount per share that we just calculated. Back over to Yahoo Finance. What we got to do is 1.35. It's got to be divided by $106. So $106.38 divided by 1.35 cents, we get 78.8. Now that is very high because it's a quarterly number. You can look at the annual number and it's likely going to be a quarter of what this is. However, we're looking for it on a relative performance so as we can track the changes in cash flow over time for a company. So with Microsoft, 78.8 seems high, but it's a quarterly number. It's not an annual number. So next we're going to have a look at the balance sheet. There are 2 metrics on the balance sheet that we are going to calculate in a moment. What we need off the balance sheet is current assets. This is cash and other assets that are expected to be converted to cash within a year. After that, we've got current liabilities, amounts due to be paid to creditors within 12 months. And then finally, stockholders' equity. This is the amount of capital given to a business by its shareholders, less any dividends issued. So what do we need to calculate? The first thing we're going to calculate is the current ratio. The current ratio includes cash, accounts receivable, inventory, and other assets that are expected to be turned into cash in less than a year. Ideally, we want this ratio to be around 2. That is the ratio that the godfather of value investing, Mr. Benjamin Graham, had come to for the current ratio. So that would demonstrate a healthy financial position for a company. Basically what it is current assets divided by current liabilities, and that'll give you the current ratio. We want that ratio to be above 2. When we looked at cash flow, it was very much dependent on the industry. When we're looking at the balance sheet and current ratios, this is very much dependent on the ratio. We want a ratio of 2 for current ratios. Next, we're going to look at what's known as the quick ratio. The quick ratio could also be known as the acid test ratio. So the quick ratio, this is liquid assets. So it's cash and cash equivalents, marketable securities, and accounts receivables divided by current liabilities. This will give us a pictorial reference of the company's ability to pay short-term debts if it comes due. So ideally, for this, again, from the godfather of value investing, Mr. Benjamin Graham, we're looking for a value of 1 or greater to demonstrate a very healthy financial position of any company. So let's go work these out. Back over to our Finance Yahoo page, over to Financials, and from Financials, we're looking for Balance Sheet. Click on Balance Sheet, scroll down. The first thing we're going to calculate is the current ratio. The current ratio is current assets divided by current liabilities. So look for total current assets here, $169 billion. We want this on a quarterly basis. Make sure that you do that. And we want the latest. So this is from the end of September. These guys are expected to report in the next couple of days. So it will be refreshed soon. So what we do is open up our calculator, 164 billion, 195 million. And we want to divide that by current liabilities. Very simple. Divided by 56 billion, 277 million equals 2.91. Remember, what we're looking for a strong, healthy liquidity position for current ratio is 2. So Microsoft checks out absolutely perfect. It ticks that box. The next thing we need to calculate is the quick ratio. So just to refresh on what we're looking for cash and equivalents, marketable securities, and accounts receivable, and we're dividing it by the same current liabilities. So back over to the page here. We're looking for, let's open our calculator, clear that off. We're looking for cash and cash equivalents right here, 15 billion, 137 million. We're looking for marketable securities. So our marketable securities in this circumstance is short-term investments. So add that, 120 billion, 634 million. And then we're going to look for accounts receivable. Net receivables here, another 17 billion we're going to add to it. So 17,390. That gives us $153 billion. So what we need to do now is divide that by our current liabilities. So if we scroll down here, we'll find total current liabilities once more, and we'll divide 56 billion into this number. So 56 billion, 277 million. And that gives us a quick ratio of 2.7. Remember, we're looking for a quick ratio of anything above 1 and a current ratio of anything above 2. We got 2.9 for a current ratio, and we got 2.7 for a quick ratio. This is a software business, so there are lower capital requirements. So although it's only generating roughly $4 per share per year, it's still a very strong cash position. And then finally, the enterprise value to operating profit comes in at 46, which is slightly above the trailing 12-month PE, which is absolutely fine because we know that every $46 that this company is worth, we're going to receive one every single year. If the company experiences growth, that ratio comes down, or if it maintains that ratio, the value of the company has to rise. So after that, it comes down to what are the earnings growth estimates from analysts. And you guys can find that through the lesson where we discuss searching for company ideas. And that will conclude the final lesson on valuations for companies. Remember, don't make this complicated. This should not be complicated. We're looking for 3 metrics. Ignore what mainstream media look at because it's nonsense. PEs don't matter. Even enterprise value to EBITDA is not a very strong metric, but we follow enterprise value to operating profit to give us a real holistic view of what the company is worth, excluding items on the balance sheet that may not be necessary. The second thing we look at is cash flow. We don't need to make it complicated. An awful lot of investors look at price to free cash flow, and that's absolutely fine. What they do is they adjust out depreciation, amortization, changes in working capital, and capital expenditure. That's a lot of work. We just want to know where cash flow is trending. And then finally, after the cash flow statements, we look at the liquidity on the balance sheet. So if cash flow is strong, we look at liquidity, we look at current and quick ratios. What they tell us is, what is the company's ability to pay down debt should it become due in the short term? We're looking for a ratio of above 2 and above 1. Those ratios are generic ratios to be used across the board, irrespective of the industry. When it comes to cash flow statements, we need to be careful on the industry that we're looking at. You cannot look at a cash flow statement, the cash flow ratios for a software company like Microsoft, and then go and look at a gold mining company and assume that the cash flows are okay on a relative basis. A gold mining company is going to need an awful lot more cash than a company like Microsoft. So do keep that in mind, that depending on the industry for the cash flow statements is depending on how much capital requirements are needed to fund those operations. If you see a very low price to cash flow ratio in mining, that doesn't necessarily mean it's a screaming buy. It just means that that company needs that amount of money for the operations of the company. And with that said, this is the very end of the final lesson on valuations.